there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 1, Understanding and Working with the Federal Tax Law from the Corporations, Partnerships, Estates, and Trusts 2026 49th edition. So, welcome to the world of tax law. For a lot of people, when they hear the word taxes, they get scared. They feel as though you're thinking another language. They automatically think of Uncle Sam. But in this chapter, we're going to take the time to understand why tax law exists and how it works behind the scenes. So by the end of this chapter, you should be able to discuss the importance of revenue needs as an objective of federal tax law, demonstrate the influence of economic, social, equity, and political considerations on the development of tax law. We'll explain how the IRS, the Internal Revenue Service, acts as the protector of revenue and how it has affected the tax law. We'll recognize the role of courts in interpreting and shaping the tax law, and we'll identify tax law sources, statutory, administrative, and judicial. We'll also list and assess tax law sources, demonstrate the ability to conduct tax research, assess the validity and weight of tax law sources, and we'll describe various tax planning procedures. So the goal is that by the end of this chapter, you'll not just understand the tax rules, but understand the why behind them. We'll also, learn where tax law comes from, how to research, and how to plan around it. So we start off with Unit 1, the whys of tax law. So again, tax law isn't just about collecting money, right? When you think about it, it's like a Swiss Army knife. We're using it for economics. We're using it for fairness, for social policy, and for politics. So the tax code in and of itself is huge and it's complicated. So federal tax law is the vehicle for accomplishing the many objectives of the nation, such as revenue needs, economic considerations, social considerations, equity considerations, as well as political considerations. So as it relates to revenue needs, yes, the primary objective of the federal tax law, it is to raise revenue, but despite the importance of fiscal needs, obviously the government, needs money to run and to operate. That's not the only thing that is in consideration. The other considerations, as we pointed out, and we're going to look at them in another chapter or in a few slides from now, rather. So as it relates to the revenue needs, raising revenues to fund the cost of government, yes, that's the primary function of the tax system. We would think that, in a perfect world, as we see here, the taxes raised would equal the expenses incurred by the government operations. But unfortunately, that is not the truth. In the US, we are actually operating at a deficit, unfortunately, right? So unfortunately, presently the federal government, their annual revenues total about 4.9 trillion, but their expenses amount to about 6.3 trillion, right? So let's make it in relatable terms. If someone, their monthly income is 4,900 and they're spending 6,300, we will say that that person is broke, right? So pretty much the US right now, unfortunately, they are operating at a deficit. So we have what's called a concept of revenue neutrality, and it guides the enacting of tax legislation. So whenever tax legislation is enacted, Congress, they're guided by this concept. So ultimately what that means is that changes, they neither increase nor do they decrease the net revenues received by the governments. So with that being said, simply stated, with revenue neutral legislation, people are going to win and some people are going to lose. So a quick example with the state and local tax cut, with the Tax Cuts and Jobs Act of 2017, for those that live in states where there are high state taxes. Like I live in New York, and unfortunately I also live in the city, so I live within the 5 boroughs, and doesn't matter how much state taxes I pay, it's capped at $10,000. So for individuals that live in states like California, those that live in states like New York, unfortunately, even if we pay close to $40,000, $50,000 in state taxes for the year, there's a cap of $10,000. So individuals like myself that live in these high tax states and earn a certain amount of income, we're the losers, right? But for individuals who don't itemize and now there's a greater standard deduction for them, they are winners, right? So in such case, again, with the revenue neutral legislation, there are winners, taxpayers who see a reduction in taxes paid, and losers, taxpayers who see an increase in taxes paid. Next, we have economic considerations. So, using the tax system to attempt to accomplish economic objectives, generally it involves changing the Internal Revenue Code. So, the Internal Revenue Code, it's basically the guidebook, pretty much the playbook. And this helps to control the economy in some manner, and it helps to encourage certain activities. So some activities that are encouraged would essentially be like charity, right? If you contribute to a charity, a 501(c)(3) organization, then you can get a tax write-off, right? It's a part of itemized deductions. Unfortunately, a lot of times it is not explained properly, because sometimes you see the commercials like 1-800 cars for kids and things like that, and someone, they might say, hey, I'm going to donate my car, I can write it off on my taxes. And then tax time comes and they realize that it benefits them more to take the standard deduction versus the itemized deduction. So some of these things, individuals are misinformed, right? So it is true, you can get the tax write-off, but it depends on your situation. But again, helps to control the economy. An example of that would be like Section 179. If I'm a business owner and I purchase equipment, rather than me having to depreciate it to allocate the cost over a number of years, I can fully expense it in the first year. So that helps to control the economy. As a business owner, now I'll be forward thinking and say, hey, you know what? I can take advantage of the tax law, or not advantage, but I can utilize the tax law to my benefit, right? So one thing that you're going to come to learn is that tax avoidance is not illegal, right? So if you use the tax law to your benefit to reduce your tax liability, that is encouraged, right? Use it to your advantage. Tax evasion, however, where you are doing things outside of the tax law, basically you're lying, right? In a sense like that, in such cases, that is illegal. That you can go to jail for, you can be fined, things of that nature. You received income, not reporting it, things of that nature. That is considered tax evasion. So tax avoidance, totally legal. Use the tax law to your advantage. Tax evasion, unless you like wearing an orange jumpsuit, I would suggest that you don't do it. All right. So again, just expanding on economic considerations, encouraging certain industries, so special tax treatment for agriculture activities, development of natural resources, railroad and banking, and encouraging small businesses. So there was just a really big change with the one big beautiful bill. So for qualified small business stock, right? If you hold it for a certain period of time, certain things happen, you get to write off the loss as an ordinary loss, not a capital loss. And then if you have the gain, a portion of it can be excluded, right? So there's some benefits to encourage small businesses to operate as a C corporation. Next, we have social consideration. So some of the tax laws, especially those related to federal income tax individuals, it can be explained by social considerations. So there's tax-free medical coverage provided by employers to encourage health insurance. There's tax benefits to encourage additional education and to encourage adoption. Then we have the deduction of contributions made to qualified charities. So as mentioned earlier, this kind of, it's to me, it kind of ties into an economic consideration because it helps to encourage certain activities, and it's also a social consideration. So the deduction of contributions made to qualified charities to encourage the funding of socially desirable programs by private individuals and companies. Because if we think about it, right? If an individual doesn't have health insurance, and an individual, let's say an organization that helps to feed the needy or to take care of those that have been displaced because of natural disasters, if individuals are not coming together to essentially help those in those types of situations, who does it fall on? The government, right? Much like, if someone doesn't have medical insurance, then what's going to happen? There's going to be credit collections and all of these other things. So some of these things they incentivize. So taxation, also the tax laws rather, also factor in the social consideration. So there's some disallowed deductions for expenditures against public policy. So if there are illegal bribes, kickbacks, those things are not allowed. And most premiums paid by an employer for group term insurance covering the life of employees, those are considered non-taxable. And the next we have is called equity considerations. So the concept of equity or fairness is relative, right? And the reason being because sometimes you hear people say things like, taxes, are not our birthright. We're not responsible for paying taxes and all of these things. And as I mentioned with the Tax Cuts and Jobs Act, state and local taxes, some people might say that's fair for it to be capped at $10,000, right? Because if you expand that amount, then this individual, they're already making a lot of money, then their tax liability is going to be less. It's not fair. For someone else, we're saying it's not fair, right? So the concept of equity, of fairness in taxation is relative, because again, reasonable persons, they can, and oftentimes they'll disagree about what is fair about the tax law and what is unfair about the tax law. So here we see the measure of equity is whether a tax is progressive. So in the federal income tax law system, it is progressive. A lot of times people say, hey, I make, $50,000, my tax rate is bop, 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 20%, 12%, whatever they think it is. But that is not ultimately how it's worked. It's progressive. So think of it like buckets. There are 7 buckets, which represent the 7 tax brackets. We start off at 0%, then we go to 10, 12, etc. Whatever it is, it changes. But just think of it, these 7 buckets. And depending on how much money is in each bucket, that determines how much is going to be taxed. So let's say if you're a single individual, the first $10,000 that you earn is going to be taxed at 10%. And then the next $30,000 that you earn is going to be taxed at 12%. And then the next 50,000, 22%. So that's kind of sort of how it works. It's not necessarily a flat rate. It's like a staggering tax rate based on how much income you earn. And then we have regressive. An example would be like the gasoline tax. So determination is made by calculating the percentage of a taxpayer's income that's used to pay the tax. And again, a tax is considered progressive if higher income taxpayers use a higher percentage of their income to pay that tax compared to lower income taxpayers. Because again, we think of it in buckets. And if someone is earning, let's say $15,000, they're only going to be in the first 2 buckets, the 10% bucket and the 12% bucket, versus someone who earns $150,000. They're probably going to be in the first 4 buckets, right? So they're taxed at 10%, 12%, 22%, and 24% on their income cumulatively. It's considered regressive if lower income taxpayers use a higher percentage of their income to pay a tax relative to higher income individuals. So one of the things that they try to do to alleviate the effect of multiple taxation is that there's a deduction for state and local taxes. Because if we think about it, unless you live in a state that doesn't have income taxes, so there's 9 states that do not have income taxes. But again, I live in New York, and unfortunately, I am subjected to both city and state level taxes. But again, there are 9 states with no income tax. So as it relates to those 9 states, we have Alaska being one, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. So if you live in any one of those states, you don't need to file a state tax return. You just file at the federal level. But for individuals like myself that live within those other, 41 states, in such case, we're paying taxes on our wages and our income at the federal level. And then we also have to pay again at the state level. So with that being said, that's why there's a deduction for state and local taxes to help alleviate the effect of multiple taxation. There's a credit or deduction for certain foreign taxes, and there's a deduction for dividends received by corporate shareholders from certain domestic corporations. So we'll learn that in a later chapter, but that's one of the biggest disadvantages of a C corporation, that there's double taxation. Corporations are a totally separate entity. They pay a flat 21% with the Tax Cuts and Jobs Act. There was a change. So corporations, they just have a flat rate, but their rate used to be progressive, similar to individuals, but now it's a flat 21%. And the issue with the corporation, the biggest disadvantage is that they pay the 21%. So let's say a corporation has net income of $10,000. They're paying 21% taxes. So what would that be? 2,100. Then let's say from that $10,000, they give $3,000 in dividends to their shareholders. The shareholders are going to be pay taxes on the $3,000. And let's say that that corporation gave dividends to another corporation, that corporation also has to pay taxes. So that would run the risk of triple taxation. So that's why there's this deduction. We'll learn about that in more detail in another chapter. Next, we have the wherewithal to pay concept. So with this concept, this recognizes ultimately the inequity of tax in a transaction when the taxpayer lacks the means, right? So let's say someone, they own a home, right? They purchased the home for $50,000, and then now there's gentrification taking place in the area, and the home is now worth $150,000. The house appreciated in value by $100,000. Imagine, right? The uproar, right? The insanity of Uncle Sam saying, "Hey, you paid $50,000 for this home. Now it's worth $150,000. Pay us taxes on the $100,000 of appreciation in value." Excuse me. I could only imagine, right? The uproar that would take place, because realistically speaking, how do you expect me to pay taxes on $100,000 that I do not tangibly have? So that's, ultimately what this wherewithal to pay concept technically means, right? So the individual, they don't have the means to pay the tax. So this concept is typically applied to transactions where the taxpayer's economic position has not changed. So therefore, the individual would only pay taxes when they actually sell the property. They sold the property for 150, so now they have $100,000. Now Uncle Sam comes knocking. Yes, he wants a piece of the pie. So the wherewithal to pay concept, the first taxation when a taxpayer's economic position has not changed significantly. All right. So again, the example, gain realized from the exchange of assets when cash is not transacted rather, the liability is deferred. The concept is only applied when, okay, the tax law specifically allows it, because there are certain situations where Uncle Sam says, you're still gonna have to, pay taxes on it, right? So just keep that in mind, because another thing is that sometimes people, what they'll try to do is harbor losses. So this doesn't just apply to gains, this also applies to losses as well. All right, so we also see mitigating the effect of the annual accounting period concept. In some cases, for example, some businesses, they have a revenue generating cycle that's more than 12 months, but we know 12 months is the maximum tax reporting period. In order to accommodate this, we have what's called the net operating loss rule, and that allows losses from one year to be used in another. And this minimizes the adverse impact of arbitrary reporting periods, right? So simply stated, I had a loss last year, right? My business only made income revenue of $10,000, and the expenses equated to $20,000. So there's a loss of 10,000. So now, yes, there was a loss in 20x5 of 10,000. Now fast forward to 20x6, we have a gain of 15,000. The loss from the prior year is now going to impact the loss, or the gain rather, the revenue, the income in the current year, essentially. All right, so lastly, for equity considerations, coping with inflation. Inflation adjustments, they're made through the indexation procedure. So that's one thing about the tax law. Every single year, we are getting a new standard deduction. There are certain limitations that are essentially adjusted and changed. So they are adjusted for inflation. And if earnings increase solely by cost of living amount, then taxes are not going to be imposed at higher rates of the increase, right? So this is also an equity consideration, because there's a lot of people that, they say the cost of groceries are growing up, but my income is staying the same, right? It's hard out here if we're being honest, right? So these are one of the things that the tax law tries to put into consideration as they make these adjustments for things annually, like the standard deduction. All right, next we have political considerations. So there's special interest legislation, there's political expediency response to the public opinion, and state and local government influences. So a large segment of the federal tax law is made up of statutory provisions. And because, again, the statutes, they're enacted by Congress, political considerations, they often influence tax law. So these are some things that often impact just the formation, the enactment of tax law. So next we move into the influence of the Internal Revenue Service. So when you think of the IRS, think of them basically like the security guard, pretty much, right? So they are the ones that are ensuring that what needs to be done is done. They are the enforcer. So the Internal Revenue Service, they act as the protector of revenue. The IRS works to get Congress to close loopholes. The laws passed by Congress enables the IRS to make adjustments based on the substance of a transaction, what actually happened. And if the taxpayer's method of accounting does not clearly reflect income, Congress allows the IRS to make adjustments to the method of accounting. So the IRS, they exert their influence in many areas of the tax law because, again, they're considered the protector. So they're the protector of national revenue, and they're instrumental in ensuring that certain legislation is being passed and that it helps to curtail to reduce aggressive tax avoidance practices, right? I sincerely believe that a lot of the tax laws that are in place now is because someone took advantage of it, right? Someone took advantage of it. So they do what they can to close certain loopholes. And in addition, the IRS, they try to make the changes, make it easier, administrative feasibility, because a lot of times individuals, they don't understand, taxes sometimes to people, it's like a foreign language. I have certain clients sometimes, just get the taxes done. I don't need you to explain it to me. Just make sure that cross all of the T's, dot all of the I's, because sometimes it could be overwhelming. Sometimes it's a lot, especially depending on the complexity of the situation. So there are tax laws that provide administrative feasibility. We have tax return audits. We have withholding procedures. We have interest and penalty assessments. So these things are also put in place to kind of make things, easier, to simplify the task of the IRS collecting the revenue and ultimately administering the law. Because again, let's think about it realistically, right? If paying taxes was voluntary, how many people are going to pay taxes? Probably not a lot, right? And the government won't be able to run. So essentially, when you are an employee, you have no choice. You have to complete Form W-4. And the only way that you are working this, employee job and you have no taxes taken out is if you sign and certify and attest in black and white and say, hey, I am not going to be subjected to any income taxes. In the prior year, I wasn't subjected to income taxes. That's the only way. Other than that, you get that job. What is going to happen is that your employer withholds federal tax. Your employer withholds federal taxes automatically. Your employer withholds federal taxes automatically from your job, right? So that kind of helps to make it a little easier, the administrative for the feasibility for the IRS in order to collect revenue. And then again, what they basically do is that what happens is that if you do not pay the taxes, then ultimately they'll hit you with interest and they will hit you with penalties, right? So these are the ways in which they kind of encourage you or strong arm you, if you ask me, to get you to pay the taxes. All right. So next we move on to the influence of the courts. We have, in addition to interpreting the statutory provisions and administrative pronouncements that's issued by the Treasury Department, the courts also have an influence. So judicial concepts related to the tax law, we have what's called substance over form, we have arm's length, we have continuity of interest, and then we have business purpose. So the judicial concepts relating to the tax law, with these things, although ultimately, this kind of ties into the wherewithal concept. In such case, did a transaction actually happen? So substance over form, because some individuals, what they ultimately try to do is that they will try to, use the tax law within the tax law to make it seem as though there wasn't a transaction, there's no wherewithal to pay. But Uncle Sam says, hey, no, no, no. There's what's called substance over form. So what they do is they'll collapse the process, right? Using the step transaction to figure out what really happened, right? So a clear example is, let's say, with gift taxes. So for gift taxes, the maximum that an individual can give away is $18,000 per year. And then after that, what happens is that the person that's giving the money away, they would need to file a tax return, right? So what happens is that let's say they want to give someone $36,000 and not incur any gift tax liability. So let's say I want to give, money to my nephew. So I decide, hey, you know what? I know that the limitation is $18,000. So what I'm going to do is give $18,000 instead of giving him the entire 36,000. I'm going to give $18,000 to my sister, tell her to give him the 18,000, and then I give him the 18,000. But when Uncle Sam looks at it, in greater detail, they recognize, wait. When we put all of these steps together, ultimately, it is me that is giving him the $36,000. I'm basically just trying to, do it within the tax law, but still ultimately in a deceptive manner. So in such case, with the substance over form concept, it plays an important role for individuals, but definitely for corporations. Then we have arm's length. This is important again for corporate shareholder dealings, because sometimes a corporation, they'll act as though they are selling something to a shareholder, or the shareholder is giving something to the corporation, but in order to avoid arbitrary losses and gains, we have this arm's length. Then we have continuity of interest, and we have business purpose. So all of these things ultimately come into play. And then lastly, we have judicial influence on statutory provisions. Some court decisions highlight undesirable aspects of present law, which has led Congress to incorporate them into the Internal Revenue Code. So this is what's called the tax benefit rule. So moving on to Unit 2, where we are looking into reconciling accounting concepts. So the vast majority of an entity's business transactions, they receive the same treatment for financial accounting purposes. So that's GAAP, generally accounting principles, and then IFRS if it is International Financial Reporting Standards. And sometimes majority of them, they receive the same treatment under federal and state tax law. However, sometimes there are certain differences. So when there are differences between GAAP and IFRS, they are essentially highlighted, right, and discussed within this book in a special place called Financial Disclosure Insights. So when you get the chance to start working with Form 1120, and we have the M1, then ultimately that basically helps to reconcile, okay, hey, the tax return shows that there's income of 1.2 million, but on the books, it shows that there's income of 1.5 million. Why is there this $300,000 difference? And these forms basically help to, reconcile the difference between the two ultimately, right? So we have that book to tax. So we have the M1, then we have the M3, and that depends on, how large ultimately the corporation is. So next we move on to the next unit, working with the tax law, the tax sources. All right. So understanding taxation, it's not just about preparing tax returns, and getting things done, right? Because there is some legality behind it. Yes, there's compliance. You want to make sure that the tax return is filed on time. But again, it's not just about compliance. There's also legality behind it. So understanding taxation requires a strong understanding of the sources of tax law. So these sources, they include laws that's passed by Congress, and the laws that are passed by Congress, they're contained in the Internal Revenue Code, the IRC, and also congressional committee reports. There's regulations, Treasury Department, and IRS pronouncements, and there's also court decisions. So as a result, the primary sources of tax law includes information from these three branches of government. We have the legislative, sometimes referred to as the statutory. We have executive, and then we also have the judicial branch. So working with the tax law involves three basic steps. So again, it's very important as you're working with these, let's say you're working with a client and they want to, make a certain decision. So we have what's called closed transactions, and we have what's called open transactions. So let's say a client, they're thinking, hey, you know what, I'm thinking about selling a property, right? That will be considered an open transaction because they didn't sell it yet. They're just thinking about it and they want to know what the implications are of selling that property, versus a closed transaction where this customer, this client now comes to you and says, hey, we sold the property. It's already done. So within the realm of the fact that the transaction was already completed, it's now closed, we have to figure out, based on the Internal Revenue Code, what are the implications for the sale of this property? So working with the tax law involves three basic steps: familiarity with the sources of the law, application of research techniques, and effective use of planning procedures. So here we see familiarity. Again, you want to be familiar with the sources of tax law. As mentioned, that is essentially the sorry about that. That is essentially knowing ultimately, okay, who is the primary source? What is a secondary source? Because if you try to, defend a position, a tax position using secondary sources, it might get thrown out, right? Think about it in, regular court. You go into a criminal court, and you bring evidence that is, probably not within the realm of what's allowed. It's going to get thrown out. Right. So same thing. You want to familiarize yourself with sources of law. You want to know how to apply research techniques. We live in a day and age where chat GPT is very helpful, right? Very helpful, but it's not always accurate. It says it at the very bottom. It says chat GPT something, I don't know verbatim, but it says something to the extent that it's not always accurate. You need to double check. You need to verify for accuracy. There's been times where I asked chat GPT something and I knew the right answer. I'm like, wait, this is wrong. And you know what it said? You are right. Right? It attested to the fact that it gave me the wrong information. So you don't just want to use ChatGPT. Maybe it's a starting point. Hey, which publication can I find more information about this, that, and third? Then you go to the actual IRS publication. And there's also some great research softwares out there like Checkpoint, things of that nature. And then you also want to have some effective use of planning procedures. You want to plan properly. Like they often say, if you fail to plan, you plan to fail. So the statutory sources of tax law are as follows. It includes the Constitution, Articles 1, Sections 7, 8, and 10. We have the Internal Revenue Code, which is the codification of the federal tax law provision in a logical sequence, right? Because imagine, right? You're trying to go to the Internal Revenue Code. You don't know where to go to find information about income. You don't know where to go to find information about deductions, credits, all of these things. No, it's in a logical sequence whereby when you need to find anything, right, in the Internal Revenue Code, let's say you want to find out more information about retirement income, right? You're not going to go to the deduction section. You're not going to go to the credit section. I'm going to go to the income section, and then I'm going to go to, included income. And then as you drill down further, you'll eventually get to retirement income. So there's been three codifications of the federal tax law. First in 1939, then in 1954, and then in 1986. Then there's also what's called tax treaties. This is agreements between countries to mitigate the double taxation of taxpayers that are subject to tax laws of those countries. And then here we just have, a depiction or visualization rather of the legislative process for tax bills. So we have the House Ways and Means Committees. A lot of times people say the president is, making the rules. So sometimes they're like afraid of, the president who goes into place. So yeah, to an extent, because obviously the president signs off on it. But at the end of the day, it's a long way before it gets to the president. Starts off in the House Ways and Means Committee, sorry. Then we have the consideration of the House of Representatives. We have the Senate Finance Committee. Then it's considered by the Senate based on, what the Joint Conference Committee and the Senate say. Do they agree? Do they not agree? And then if so, then it makes its final way to the president. Does the president approve it? Or does he veto it? If he approves it, then it's incorporated into the Internal Revenue Code, right? So it's a whole process. So I want people to keep that in mind. It's not just that whatever the president says goes. There's a legislative process for tax bills being incorporated into the Internal Revenue Code. And then we just have this quick example of a compromise in the Joint Conference Committee process, because again, we're dealing with, humans. We're dealing with individuals that have differences of opinions, differences of perspectives, and things of that nature. So what they want to do is come to figure out, hey, you know what? We don't fully agree, but how can we compromise? Just like in a relationship, right? You like pasta, the other person likes what are different types of pasta? One person likes linguine, the other person likes penne, right? Maybe you decide, hey, let's make a meal that infuses both, right? Let's put some linguine, let's put some penne, right? We still have pasta. We both have what we like, kind of sort of thing, right? So whenever the House and the Senate, they don't fully agree, they basically figure out how to come to a compromise, something that works for both parties that they can agree to. So next we have the arrangement of the Internal Revenue Code. Again, the key reason is that it's just making things a little bit easier. So we have subtitle A starts off with income taxes, then we go into normal taxes and taxes. So we start off with the subtitle, then we have the chapter, then we have the subchapter, then we have part one, then we have part two. It just makes life so much easier, right? That's like imagine you're going into a drawer and you're looking for a vest, right? Or you're looking for underwear. And in this drawer, there's shirts, there's shorts, there's pants, there's socks, there's everything. You're fumbling around in that drawer, right? To try to find what you are looking for. Versus if you have one specific drawer for vests, one specific drawer for underwears, one specific drawer for socks, etc. You know exactly where to go to find what you need. So that's essentially the purpose for the codification of the Internal Revenue Code, to make things a little easier for tax research, tax planning, and things of that nature. And so that way, even a non-tax professional, if they wanted to go to the Internal Revenue Code, I mean, some of the verbiage is a little confusing, even to the professionals, but for the most part, at least they have a bit of guidance. They can know kind of, sort of where to go. So next we have citing the code. So the two S's, that's an abbreviation for section, the section number, then the subsection designation, paragraph, subparagraph designation. So all of these things are important, especially when you are, using this tax research, and let's say you're in tax court, right? I can imagine if a lawyer goes and they cite the wrong part of the tax law or just law in general, it might get thrown out, right? Their case cannot stand because they are not citing the right place, I would imagine, right? So same thing in the Internal Revenue Code. You want to make sure that you understand how to cite the code correctly. It's just like if you want to open a lock. The combination, I remember back in the day in school, we had lockers and you had to open the combination the right way. You had to turn it right, then you had to turn it left, then you had to turn it right. If you did not turn that lock the right way, it will not open. In the same sense, citing the code, you have to do it the right way. Use the right abbreviation for section, subsection, etc. So next we have administrative sources of tax law. So we have Treasury Department regulations, we have revenue rulings, we have revenue procedures, we have notices, various other administrative pronouncements. So with that being said, Treasury regulations, these are basically issued by the U.S. Treasury Department under authority granted by the Congress. And what they do is that they're interpretive by nature. These Treasury Department regulations, they basically provide taxpayers with guidance on the meaning of the application of the code, right? So regulations, they can either be proposed, they can be temporary, or they can be final in form. So we're going to see that in the next slide. So if it's issued as proposed, that means it's like a preview of what the final say so is going to be, right? It's proposed. It's just like, a marriage proposal. Just because I proposed or the person proposed, it doesn't mean we're married, right? It might happen or it might not happen. So therefore, it does not have the force and effect of law. It's not final. We ain't married. The ring is on the finger, right? But we're not married according to the courts. So proposed, their preview of the final regulations, but has no force and effect of law. Temporary regulations, they're issued when guidance is needed quickly. They have the same authoritative value as final regulations, right? So sometimes the Treasury Department, again, they'll issue these when there's immediate guidance that's needed, right? So these regulations, they often take place when there's recent legislation that takes effect immediately. Next, we have final. I mean, it's final, it's law. So final regulations, those are force and effect of the law. So an example of a regulation citation will be regulation section 1.2, and the prefix that designates the regulation under the income tax law. It refers to the regulation under section 2, and then there's some subparts, and then the numbering patterns of these subparts, they have no correlation with the code subsection. So that's why for those of you that decide to venture into, let's say, tax research, use tax software. I know they have CIA research. I think it's like IntelliConnect or something of that nature. I remember when I worked in Big Four, They had tax research software that we can essentially utilize. So you want to make sure that you use these software, because sometimes there might be some nuance that you're not sure about, and you code it the wrong way and it gets thrown out. So very important to take advantage. And this is just an example of a proposed regulation, what it would look like, in temporary regulation. So we see it says temp reg, prop reg, which is short for proposed and temporary. And then next we have our revenue rulings. So these revenue rulings, they're officially issued by the National Office of the IRS. And these are designed to provide interpretation of the tax law. So they do not carry the same legal force and effect as regulations, right? So less legal force and effect than the regulations, and they're issued in what's called the weekly internal revenue bulletins. And this is just an example of a citation for revenue bulletin. So as we see here, this is a part of revenue ruling number 8, right? It appears on page 877 of the 16th weekly issue of the Internal Revenue Bulletin for the year of 2024. Next, we have what's called revenue procedures, and these deal with the internal management practices and procedures of the IRS. So these are concerned, or they're issued rather, in the weekly internal revenue bulletins. And again, this is just an example of how it will be cited. Next, we have notices. Notices, they're issued when there's immediate guidance needed by taxpayers and tax practitioners. So typically, this guidance is transitional because the IRS, maybe they're working on permanent guidance for a particular topic, right? So sometimes, the IRS, maybe there's something relating to required minimum distribution rules. Or I remember when COVID happened and they had to change with how much can be taken out of your IRA without there being a penalty and all of these different things. There were notices sent. So individuals understand, hey, this is how it's going to be applied. So there were guidance, immediate guidance was needed. So that way individuals, they wanted to make sure, hey, before December 31st, I want to know what's the maximum amount that I can take out from my IRA without the 10% penalty, and how it's going to be treated ultimately. And this an example of how it would be cited. Then we just have some other administrative pronouncements. So we have letter rulings. These are issued by a fee, or for a fee rather, by the National Office of the IRS if the taxpayer requests, right? So this is where someone, they want to know, hey, if I make this decision, how is it going to be treated? Then we have technical advice, TAMs, technical advice memorandums. Then we also have determination letters. So with the letter rulings, again, um, taxpayer has to pay for it. They request it. And then that's ultimately where the IRS says, hey, if you sell this property on this date for this much to this person, this is how the IRS is going to treat it. And this is an open transaction because, again, it's not closed. It has not yet happened. And this applies only to the taxpayer who asks for and obtains the ruling. So what applies for Sally does not apply to Sarah. Sarah's situation is a little different. So letter rulings apply specifically to that person. And then here we see post 1984 letter rulings. They may be substantial authority for purposes of the accuracy related penalty. It's limited to the restricted pronounced areas of taxation, right? So let's say you got a letter ruling for a piece of property, right? A personal property that you lived in. It might be a little different for rental property, right? So you have to realize that it's within that pre-announced area of taxation. And this is just an example of how it will be citing, or cited rather. Then we move on to technical advice memorandums. The National Office of the IRS, they release these weekly, and it resembles letter rulings that they basically give the IRS's determination of an issue. They deal with completed transactions. Remember, we have open transactions and closed transactions. So completed basically means that it already happened. And then it's issued in response to questions raised by taxpayers or IRS field personnel during audits. Then lastly, we have determination letters. These are similar to letter rulings. They're issued at the request of taxpayers and they provide guidance concerning the application of the tax law. They differ from individual rulings in that the issue source is an IRS area director. It's not the national office. All right. And again, they also involve completed transactions, but these determination letters, they're not published by the government. They're only made known to the party that's making the request. All right. So next we just have this overview of the federal judicial tax process. This is just showing ultimately that there are 5 federal courts that have jurisdiction over tax disputes between the IRS and taxpayers. So we have the U.S. Tax Court, the U.S. District Court, the U.S. Court of Federal Claims, the U.S. Court of Appeals, and then we also have the Supreme Court. So these are the 5 courts. And then we have what's called a trial court. So this is also known as a court of original jurisdiction. And the taxpayer has the choice of 3. They can choose the U.S. District Court, the U.S. Court of Federal Claims, or the U.S. Tax Court. In small cases, division, they only hear cases that are $50,000 or less. So it's important to understand, certain things in court law. If you are the plaintiff, that's the party that's requesting action in court. So I'm suing, you. So therefore, I'm the plaintiff. The defendant is the person whom the suit is brought against. So let's say I'm suing Sally, right? I am the plaintiff. I'm suing Sally, and Sally, she is the defendant. I brought the suit against her. And sometimes a court uses the terms petitioner and respondent rather than plaintiff and defendant. So in such case, I would be the one that's petitioning for Sally to come to court. She is the respondent. So continuing on with the judicial sources of tax law, there's differences between various trials court based on the number of courts. So there's only 1 court of federal claims and only 1 tax court, but there's a lot of U.S. district courts. As it relates to the number of judges, district courts, they have a number of judges, but only 1 judge hears a case. The Court of Federal Claims has 16 judges, tax court has 19. As it relates to location, the Court of Federal Claims, they most of the time meet in Washington, D.C., and each state has at least 1 district court. And the tax court is officially based in Washington, D.C., but sometimes the judges, they'll travel. As it relates to the jurisdiction of the tax court and district court, the tax court only hears federal tax cases. As it relates to the jurisdiction of the Court of Federal Claims, they have jurisdiction over any claim against the U.S. So with that being said, they also hear non-tax litigation cases as well as tax cases, jury trial. This is available only in a district court. Payment of deficiency. So before the Court of Federal Claims or district court are going to hear a case, the taxpayer has to pay any taxes that were assessed by the IRS, and then they got to sue for a refund. All right. So they pretty much hit you with the okie doke, right? So hopefully you win, you get your money back. And if you lose, Uncle Sam already got his money, right? So next we have appeals. Appeals from a district court or a tax court, the decision goes to the appropriate U.S. Court of Appeals. And then lastly, sometimes we know there's always gray areas, right? So there's gray areas in tax law. Sometimes, of course, they disagree to the proper tax treatment of an item. So whenever there's these differences in judicial authority, the taxpayer, they have to consider how a specific court might rule when choosing the most favorable place, the most favorable forum, court to appeal or to present their case rather. All right, so here we have this concept summary. Here is basically just going over the judicial sources of tax law and just kind of, summarizing exactly what we just pointed out. Next, we have appellate courts. So a trial court can be appealed to the appropriate U.S. Court of Appeals. There's 11 geographic circuits, and the circuit for the District of Columbia, and the Federal Circuit Court, they appear. So in such case, again, all courts, they need to follow the decisions of the U.S. Supreme Court. The U.S. Supreme Court is pretty much like the head honcho, right? They're in charge. And the role of appellate courts, they're limited to review of whether the trial court applied the proper law. So as it relates to appealing from the tax court, there's a national court that hears and decides cases from all parts of the country. They decide a case under a policy known as the Golson Rule. And then as it appeals to the Supreme Court is by writ of certiorari, and it's only granted for those cases that the Supreme Court wants to hear, right? Because they're, the Supreme Court, they have a lot going on, right? They're not going to just take any and every case. So not all cases are selected. So definitely want to keep that in mind. And next we have the court weight as it relates to the precedents. So presidential weight from high to low, as mentioned, the Supreme Court, they're pretty much the head honcho. Then we have the Circuit Court of Appeals. Then we have Tax Court, which is, regular. And then we have the U.S. Court of Federal Claims. And then we also have the U.S. District Courts. And decisions of small cases division, tax court, they have no presidential value and they cannot be appealed. So there's certain areas of tax law that unfortunately they cannot be appealed. So next, this is just going over tax court. So we have three types. We have regular, which is new issues. We have memo, which is like routine application. And we have summary, which is for, small cases. Memo decisions, they're common and they're published by private publishers like CCH or RIA, which I mentioned were some of the research software out there. And this is basically just showing, how it would essentially be cited for a temporary citation versus a permanent citation. So with the memorandum, as mentioned, these are for like routine application. So decisions deal with cases that involve only the application of already established principles of law. Memorandum decisions, they're available on the U.S. Tax Court website. And summary opinions, they're issued in small tax cases and cannot be used as precedent in any other case. And next we have the tax court. The memorandum decisions, they're published as mentioned by both the Commerce Clearing House, CCH, and the Research Institute of America. So this is just showing you the different ways in which it can be cited, and that's why it's a benefit to have one of these tax research softwares that helps you with the citing. So here we have district court, court of federal claims, court of appeals. All right, so this just, goes on to just continue to talk about, how they decide, how they deal with federal tax matters and how they are reported. And then this is just some examples of citations. So we'll just go through this. If you want to take the time to review it in further detail, feel free. This is essentially illustrating the different ways that the same decision from the Supreme Court can be cited. And then we look at tax treaties, and these are some other sources of tax law. So tax treaties, again, this is where the U.S., they sign a treaty. Sometimes it's called a tax convention with the foreign country. And this basically assists tax enforcement. But the main goal is to avoid double taxation. So these treaties, they affect transactions involving U.S. persons and entities that operate overseas or they invest in a foreign country ultimately. All right, so those would be found at tinyurl.com, tax treaties. So, depending on the situation, sometimes there are individuals that are foreign citizens, but they're making money in the US and they essentially have a treaty with the US. So therefore, they reported on the US tax return, but they don't pay taxes because they pay taxes in their home country ultimately. So there's neither a tax law nor a tax treaty that takes legal precedence. When there's a direct conflict, the most recent item is going to take precedence. Next, we have tax periodicals. The use of tax periodicals, it can shorten the research time needed to resolve a tax problem. There's an article that's relevant to the issue that can ultimately provide the references that are needed to figure out, well, what are the primary sources of tax law that are going to apply. So some examples might be citations to judicial decisions, regulations, and other IRS pronouncements. All right, so I know that was a mouthful. We covered a lot in that unit. And now we are moving on to working with the tax law, locating and using the tax law sources. So tax law consists of a body of legislation, right? So we have the Internal Revenue Code sections, We have tax treaties, we have administrative, which deals with the regulations and the rulings, and then we have judicial, which are the court cases and their pronouncements. So working with the tax law, it requires being able, you got to know how to locate it effectively, right? And efficiently, how to use the sources, because if you source a secondary source and not a primary, there might be a chance that, your argument will be thrown out. So it's very, very important to know ultimately how to use them. So one key thing that is, always recommended, unless the problem is simple, right? Unless it's like, let's say somebody wants to figure out, hey, how much of my retirement income needs to be reported, especially let's say with like a Roth IRA case where the individual, let's say maybe they had the Roth for more than 5 years, but they need to figure out their basis. Kind of, it could be kind of simple for the most part. They could look at the publications and figure it out. Or let's say an individual has income, right? I remember a case. I have a client, she takes care of her autistic grandson, and for whatever reason the company issues a 1099 NEC. She is not self-employed. She's not doing or taking care of her grandson for a motive. She is not running a business, right? She's just receiving other income for taking care of her grandson. So therefore, we had to go back and forth with the IRS. I had to give them the publications and saying, hey, it's a simple case for the most part. Based on the rules for self-employed individuals, she's not in it for a profit motive. She is not running a business, right? So gave them the regulations. So in simple cases like that, we don't need to go that hardcore, right? But let's think about these complex corporate transactions, or complex situations with individuals, high income earners. We're dealing with trust estates, all of these other things. You want to make sure that you're finding the right sources. So therefore, you would utilize one of these tax services. So in the past, these commercial tax services, they could be classified as annotated, whereby they're organized by the Internal Revenue Code, or they can be considered topical, organized by major topics, right? But obviously now with the advancement of technology, they become more electronic, so it's no longer appropriate. So sometimes you could pretty much just, do a little search, a little keyword, what you're trying to figure out. So even though that case was a little simple, if I wanted to use the tax software, I could type in something like self-employment, right? Requirements, other income, and things of that nature to find ultimately get to my conclusion of, based on the tax law, this is how this transaction should be completed. We didn't hear back yet from the IRS, but we shall see what their decision is, and if they come back with something else, I'm ready to put the pause up, right? Because I'm standing 10 toes down. But here's a partial list of the available commercial tax software. So there's CCH and TeleConnect, there's Thomson Reuters Checkpoint, Practical Tax Expert, there's Tax Management Portfolios, which is linked to Bloomberg Tax, there's Parker Tax Pro, there's Martin's Law, Federal Income Taxation. There's Thomson Reuters, LexisNexis. When I was in corporate America, that's what we use, LexisNexis. So again, there's a myriad of these commercial tax softwares, but the key thing is you need to know how to use it. So effective utilization of online research services, they're going to help a tax professional complete projects efficiently. You want to carefully choose keywords for the research. Take advantage of the connectors. Be selective in choosing the data to search. Use a table of contents, an index, or a citation when appropriate. And you always want to check for current developments, because what's in the research program might not necessarily be the most up to date. All right. So you also want to be aware of that. Next, we have using non-commercial tax sources. So again, this is like what I was mentioning with Chat GPT, right? So Chat GPT might be right, but it might be wrong. It can be a starting point. So we know that the internet, it provides a wealth of information at no cost to the researcher, because obviously these tax research softwares, they ain't free, okay? And a lot of them costs a pretty penny. So for some individuals, they might not have the money, right? So they use the internet. But websites provided by accounting and some consulting firms, sometimes they do provide valuable, guidance on a topic. So websites provided by accounting and consulting firms, publishers, tax academics, libraries, and governmental bodies. The Internal Revenue Services site offers downloadable forms and instructions, interpretations of regulations, and news update items. There's blogs. And again, quality of tax information, though, keep in mind, it cannot be completely relied upon. So you always want to go back and check the source, especially when it live in this day and age where there's a lot of information circulating on social media that is a lie, right? And a little bit of a lie mixed with the truth is still a lie, right? So some of the things that are being, thrown around on social media sometimes is not always accurate. So you always want to double check. Just like the other day, someone sent me a video, talking about the wash sale loss rules and how they don't apply to cryptocurrency. So simply stated, what Uncle Sam does is that, and again, I believe they're closing the loophole, and they eventually will for cryptocurrency as well. Is that if you sell the cryptocurrency at a loss, or let's say wash sale loss overall, you sell stocks at a loss, right? And then you buy back a similar stock, then in such case, what individuals will try to do is that they'll claim the loss, but they pretty much just bought back the same stock. Uncle Sam says, no, not allowed, right? But it's not yet allowed for cryptocurrency. So someone was on a podcast or something of that nature, and they were basically saying, oh yeah, cryptocurrency, it doesn't apply, you can just take the loss. But what he didn't mention, what he failed to mention, is that let's say somebody took this information and they went and they sold their cryptocurrency at a $20,000 loss. In their head, they're thinking, hey, wow, okay, I made $70,000 of income, I'm going to claim this $20,000 loss, and I only have to pay taxes on 50,000. And that's incorrect. Capital losses are capped at $3,000, right? So with that being said, it's going to take that individual, let's say they never engage in any other cryptocurrency, it's going to take them about 7 years to write off that loss, right? 3 times 7, 21. So about six and change, really seven, right? So ultimately, that information that they gave out, it was true, but they left out a key component of the fact that there's a maximum capital loss of 3,000. Worse yet, if the person is filing married, filing separate, it's half of that. So it's going to take them 14 years to write off that $20,000 loss, right? So again, there's quality information out there, but you always want to double check and verify the information. So we move on to Unit 5, working with the tax law and research. We are starting to wind down and get to the end of the presentation. So with tax research, again, the crucial part is the ability to find competent and a professional conclusion to the tax problem. The problem can originate from either a completed or a proposed transaction. So as mentioned, if it's completed, it's considered closed. You already sold the property. If it is proposed, then it is an open transaction. I'm thinking about doing it, didn't do it as yet. So that definitely plays a significant role. So when a client comes to you with a situation, you want to ask them, did it already happen, or are you thinking about, what you're doing? So unless the problem is simple, again, the code section is known or there's a regulation of the point, the research should begin with a tax service. Again, unless it is simple. So tax research involves first and foremost, what is the problem, right? What is the problem that we are trying to fix? So, or get a resolve. So you identify and refine a problem. You locate the appropriate tax law sources. You assess the validity of the tax law sources. Because again, let's say you chat GPT. Again, I keep going back to that. It might not be accurate. So you need to assess the validity. Is it a primary source of tax law? You arrive at the solution or an alternative solution, given, you also want to factor in the non-tax factors. Then you want to effectively communicate the solution to the taxpayer, and you want to update the solution in light of any new developments. So this is just a visualization of the tax research process. Again, the key thing, you want to start off with what is the problem, and then the end goal is ultimately getting to some type of resolve. So next we have assessing the validity of tax law sources. So when assessing the validity of a regulation, the following observations should be noted. So the burden of proof is on the taxpayer to show that the regulation is wrong, right? What they say, like, innocent until proven guilty, right? So the IRS is right until proven wrong, pretty much, right? So a court, however, they may invalidate a regulation that varies from the language of the statute and has no support in the committee reports. And if the taxpayer loses a challenge, then the negligence penalty may be imposed. So that's another thing. When you're coming up against, Uncle Sam and the Internal Revenue Code, you want to make sure that you know what you're talking about, because if you're wrong, you might also get penalized. So the accuracy related penalty provision, it deals with the intentional disregard of rules and regulations on the part of the taxpayer. And then, as we know, there's final regulations tend to be three types. We have procedural, these are like housekeeping type instructions. Then we have interpretive. This is basically where they rephrase what's in the committee reports in the code. This is hard to get overturned. And then we have legislative. These allow the Treasury Department to determine the details of law. So Congress has delegated its legislative powers, and they generally cannot be overturned. So these are all of the different things that you want to keep in mind. And next we have revenue rulings. With the revenue rulings, as we know, they carry less weight than regulations, and they are not substantial authority in court disputes. And next, we have these judicial decisions. So, with the judicial sources, they carry less weight than the decision issued by the appellate court. And the decision of the appellate court in the taxpayer circuit, it carries more weight than one rendered by the appellate court in different circuits. So, primary sources, you've heard me say that before. Primary sources, these are essentially the most important, right? Because these are the ones that hold the most weight. So with the primary sources, we have the Constitution, we have legislative history materials, statutes. So for example, the Internal Revenue Code, statutes are basically laws. We have treaties, treasury regulations, IRS pronouncements, and judicial decisions. So in general, the IRS considers only primary sources to constitute substantial authority. But then we do have some secondary sources. Those are the legal periodicals, treaties, legal opinions, IRS publications, and other materials. And in general, the secondary sources are not considered authoritative. So you want to keep that in mind as you do your research. Next, we have communicating tax research. The tax researcher, they should prepare a memo or a letter once the research is completed. So first and foremost, you want to make sure that you have a clear statement of the issue, right? You ever, let's think of relationships, right? Let's say there's a problem in a relationship. One person is saying this is the problem, they explain it, and then when you ask the person to say what they understand of what you just said, they said something totally different, right? So one thing you want to do is you want to be clear on what the issue is. What is the root of the problem that we are trying to solve? So when, as a tax professional, we are communicating with the client, the key thing is, let's restate it. I remember when I used to work for TurboTax, that was one of the key things that they would say. We had like a script. Whenever we answered the phone, the client, they called in with their concern, we had to restate the issue, because imagine if I'm going in my head with what I think the issue is and I was wrong the whole time. I'll just be wasting time. So in such case, you want to have a clear statement on what the issue is, short review on the facts that raise the issue, review the relevance of the tax sources. What are the assumptions made in arriving at the solution? What is the recommended solution? The logic behind it, right? What's the reasoning? Because again, a lot of times when you're in the tax court, or even dealing with, someone at the IRS, you're dealing with human beings. A lot of some of these things are logical. Yes, we're dealing with numbers, to an extent, but a lot of it is logic. What's the reason behind it? And then you also want to provide them with the references that were consulted in the research process. Then we have, using generative AI for tax research. Chat GPT, like I said, is great, but you cannot always rely on it. So you can use generative AI to perform calculations, making observations. You can use it to draft the client letter, to brief the court case, to draft the meeting summary. But the challenge is that these tools are not always up to date with the latest tax development, and it may not be able to handle complex fact patterns. And again, at the very bottom of Tax GPT, it says that it is not always accurate. Believe it. There's a case with the lawyer. I actually need to do some more research on it, but I've heard it before about how he used Chat GPT to basically draft up something for his court case. He took it into court, and it was a made up section of law, and he lost his license as a lawyer. Can you imagine? I couldn't even fathom. Okay, I guess he was the martyr for other lawyers to let them know, do your research. He was disbarred, right? Imagine you spend all these years in school. I can't even begin to imagine what his student loans are, right? And you were disbarred because of, in a sense, it's like lack of due diligence, right? So again, I love ChatGPT. It is a great tool, but within reason, sometimes it gets things wrong, sometimes it makes things up. So you always want to go back to the primary source. So this brings us to our last section, working with the tax law, tax planning. So the primary purpose of effective tax planning is to maximize the taxpayers after tax wealth. So again, as I mentioned earlier, in the review, tax avoidance is not illegal. Tax evasion is. So whatever you can do ultimately to, reduce the tax liability, go for it. Within the tax rules, obviously, you don't want to do anything too aggressive and things of that nature, but for the most part, within reason, take advantage of the tax law, right? It's there for you to take advantage of. A lot of times people, they get upset at high income taxpayers, they're taking advantage of the tax law. You're right, they are, right? And it's not illegal to do so. So even as individuals who are middle class and things of that nature, there are things that you can do to take advantage. Put aside more income, for retirement. Put more into your 401k. If you're self-employed, max out your self-employed contributions. You like to give away, put more money into charity, right? Things of that nature. You're putting money into a charity, a cause that you care for. You might not like the government, right? You might not like Uncle Sam. So you might say, hey, before I give my money to Uncle Sam, I'm going to put it into a charity. You get a benefit for that. It's not illegal to do it, right? So again, a secondary objective of effective tax planning, you want to reduce, defer, or eliminate the tax. This ties into what I was saying. Tax avoidance is the legal minimization of tax liabilities, and the goal of tax planning. Tax evasion is the illegal minimization of tax liabilities. It suggests the use of subterfuge and fraud as a means to tax minimization, and it could lead to fines and jails. There have been a lot of celebrities, unfortunately, that had to, spend some time in orange, unfortunately, because they evaded tax, they didn't avoid tax. So you'll choose the business entity with desired tax attributes as a tax professional. This is one of the benefits that you can provide to clients. You can walk them through different scenarios. Hey, if you structure your business as an S corp versus a C corp, or as an LLC versus a S corp or a sole proprietorship, these are the benefits. With tax planning, it preserves formalities by generating and maintaining clear documentation. It is very, very important, and it acts in a manner consistent with the intended objective. So that brings us to the end of chapter 1, understanding and working with the federal tax law. So now that the lesson is ended, you should have learned to discuss the importance of revenue needs as an objective of the federal tax law. So again, that's the primary objective of the tax law, to raise revenue. But again, that's not the most important thing. We also spoke about how with the federal tax law, we were able to demonstrate the influence of economic, social, equity, and political considerations on the development of the tax law. We also spoke about how Uncle Sam is the protector of the law. Think of them like the security guard, and the IRS. They exert their influence in many areas, and they basically help to secure the passage of legislation. They essentially help to reduce aggressive tax avoidance practices, and they also, administer laws for administrative feasibility to get their money, right? And to ensure that people comply. We also recognize the role of courts in interpreting and shaping the tax law. We also identify tax law sources, those that are statutory, those that are administrative, and those that are judicial. We also listed and assessed tax law sources. We demonstrated the ability to conduct tax research. We also assessed the validity and weight of tax law sources. We described various tax planning procedures. So this brings us to the end of chapter 1.